And joining me on the panel tonight, we have David Novak from Wealthwise Education and Russell Muldoon from Montgomery Investment Management. What a day to be having the show, and I guess the question on everybody's lips is this a correction or is this a crisis? But I guess the big question for a lot of fundamental analysts out there is, do we need to revalue the market to a lower valuation because we're in a lower growth world? I mean, 1974 to 1980, the average was only 7.5 PE ratio.
Right. I think from a market's perspective, I think that might hold some credence, but I think very few people invest in the market unless you're an index investor. Very few people hold the entire 200 shares in the ASX 200 or the 300 shares in the ASX 300. So I think the way we approach the market is we try to turn it off and we focus on high quality businesses first. As David said, you've got to be selective. That's rule number one. You've got to own high growth businesses and high quality businesses that are leader in their industries and have bright prospects for the future.
And are they becoming harder to find?
Oh, look, they're always hard to find because they're always priced pretty well to perfection, but it's our job to keep sifting, keep looking, keep hunting, keep looking for those high quality businesses where we can position our investors' funds well. And these sort of market conditions that we're having at the moment, we have one in year 2000, we had one in 2007, 2008, we had one in August 2012. Good businesses over that time frame have continued to grow higher and higher and higher. So the opportunity and the volatility you see, and we're seeing some good businesses down 10 or 15% in the space of a week and a half. To us, that's an opportunity.
So can I ask you how much cash you're holding in the fund at the moment?
Oh, look, we've traditionally held quite a lot of cash for opportunities. We've got about 25% in the fund in cash, and that's been up as high as 50. I think the private fund, for example, has averaged closer to 45, 50 over the life. So it's not the highest it's ever been, but certainly it's compared to our peers who are literally forced by asset consultants to be more invested all the time. We're fortunate in that we don't have to swing if we don't need to swing. So we can sit on the sidelines, wait for those high quality businesses to present, and then swing when the opportunity comes available to us.
Yeah. Russell, we'll start off with you. In terms of energy stocks, it's a difficult one because the underlying commodity is falling. Do you see this as an opportunity?
No. Look, I think since 2012, 2013, we've been saying really you want to avoid the commodity sector. I think that thesis is now playing out and has largely played out. The reason for that is we had the view that China really needed to rebalance its economy away from heavy capex investing, building a lot of infrastructure, and rebalance its economy to more of a consumer-driven economy, which Europe, US, Australia, that's a lot of their GDP is consumer-driven rather than fixed asset investing. The implication of that, however, is if you slow down your fixed asset investment, it becomes a lot more intensive for commodities, energy, iron ore, and we're seeing a lot of those commodities to continue to fall as China attempts to rebalance their economy further. We've got supply increases coming in the US in shale oil. You got demand falling across the world. Europe's having a bit of a contraction, but potentially underlying, and there's a huge investment in China in solar.
Okay, so energy at 40 US a barrel doesn't look attractive?
No, it doesn't to us. It doesn't to us because we have no idea where oil price is going to go. We have no idea where iron ore price is going to go. We have a feeling it's going to be lower within the next 12 months, but that's just our view internally. We think China's problems are here to stay for quite some time, and it's going to be quite a drawn-out issue that we're facing, particularly for the commodities markets. So look, we're not interested in that space at the moment.
Because Russell, if I didn't tell you the company and said half-year net profit was up 49%, revenue was up 69%. And the interim dividend up from 4 cents to 6 cents,
Oh, look, it's all about quality.
It's
all about quality of earnings, though, and you have to look underneath and what's driving that result. So, yep, that certainly attracts us, and we would go, okay, let's have a bit of a look at this company. But the fact is, a commodity producer can control its production to a certain extent, but mines or oil wells are finite. They deplete. They've got to find new things, and they just constantly keep on chewing up cash, trying to find new things, and it's just not attractive to us.
Flight Centre, Russell.
Yeah, look, this is one we've certainly earned in the past. As you said, high quality business, very well managed. It's been one of the true success stories in Australia. It's growing its earnings offshore. It's growing in the UK. It's trying to expand into the US market. I think earnings now, from a contribution standpoint, about 20%. So as the currency falls, it's got a bit of currency offshore. So it looks really good. The only issue we have is recently we've seen a lot of competition online come into the sector, and that concerns us. So we're seeing companies like Expedia, these are big businesses in the US, like billion-dollar companies. Skyscanner, for example. Now these guys operate on very, very thin margins compared to a Flight Centre, for example, and Flight Centre itself operates on very thin margins. But what we think is, like car sales, realestate.com.au, those online businesses, and the price transparency they've created throughout their respective industries, cars, for example, you can compare 400 cars online now. So when you go to your dealer, you go, well, I can see this, and massive amount of price transparency. We think that is now coming into the travel industry through the OTAs, online travel agencies. We think margins for this particular business could be under threat in the years to come. So, look, we used to own it. We don't anymore. We think there's a structural issue potentially here, longer term, so that we're not in this sector at the moment.
Okay, so Russell, most things in life move in cycles, especially in the stock market, and especially in economies. And we know that China has been in this down cycle. Growth peaked at 14% in 2007. It's now probably below 7% in 2015. But at some point, that tide has to turn, right?
Well, we don't think it will. Well, not ever, no. It's a brave man to say ever, but look, commodity cycles are long and they're drawn out and they're very protracted. It's not uncommon to see a commodity cycle go for 10 or 15 years on the bull cycle, 10 to 15 years on the down cycle. We're only 3 years into the down cycle. This could go for another 10 to 12 years. Sure, the BHP CEO is out there saying, we're hoping on stimulus in China to increase investment in infrastructure to get demand stimulated, because they really are the swing factor at the moment. And you would, as a CEO, you want to see demand be created for your own product, right? Particularly in iron ore. But we don't think that's happening. We think that China has a lot of capacity in terms of their infrastructure, 30-40% over what they need, and that's going to satisfy growth for a long, long time. So we think this is going to be one of those projected cycles. It's going to be a long, long time. We think iron ore could fall to probably US $40 a tonne. I think it's about 50, 55 at the moment. So look, we're still very, very cautious on this part of the market and commodities. We have zero exposure, and we actually run a fund where we can actually short some of the higher cost iron ore producers, and the team that runs that fund still have considerable shorts on some of the companies that have a lot of debt on their balance sheets. So look, we're negative. I can see the reason to be positive when the CEO is coming out and say, look, if this happens or this happens, we look pretty good. But from our perspective, that's just punting on really a binary outcome. It could happen, it could not happen. It's
leads very well into our next email. We've got one here from James, who asks, when are we going to see the bottom for resource stocks? Will we be looking at possible mergers happening? And with oil price still in decline, is Santos a possible takeover target? When will we see this bottoming in the resource space, do you think?
Look, I think the M&A side is particularly interesting, because one thing we know is that really we need a supply shakeout. We need some of the producers to fall by the wayside to get the supply side out of the market. We don't see demand growing. In fact, we actually see demand coming off. And you've got Vale, for example, increasing production, still in this market. So we really need a supply response. We need the higher cost producers like the Atlas, the Fortescues. We think they could be under a lot of pressure in the near term. That will see some supply coming out. And then what we see is, only the real low-cost producers are going to survive. Your Rios, your BHPs, your Vales, your big boys. And then underneath that, those that do have high-quality deposits, they really need to get together, combine their resources, combine their infrastructure, combine their shipping, et cetera, et cetera. We need a lot of M&A activity for these guys to thrive, and under commodity prices being depressed for longer.
Okay, so we have Ken on the line from Brisbane. Ken, welcome to the show. What's your question tonight?
Thanks, Julia. Could David and Russell tell me their opinion on MyNet Phone and Big Air Group, as they just reported recently.
Sure. So looking at the telco space and the smaller side, you know, we have seen some acquisitions in the mid-size space in this area, but what about MyNet Phone and Big Air, MNF and BGL? We'll start off with Russell. What are your thoughts?
Sure. Some good results this reporting season. Both had earnings growth greater than 20%. I'm looking at MyNet Phone right now. So they had, looks like earnings growth about 24%. And that's good from a little company that focuses on VoIP, so voice over the internet protocol, and it's done really well. It's bought a lot of small businesses privately for very cheap multiples, talking 4 or 5 times EBIT. It's moved on to the market. That probably translates to a PE of 7 or 8, and the business itself is being valued 20, 30 times earnings plus. So it gets a huge earnings accretion when it buys these things privately and lists them on the stock market effectively through acquisition. They didn't provide any guidance other than continued organic growth and complementary acquisitions that I'm seeing here. But look, it's in a great space, high levels of recurring revenue, very strong balance sheet, and they're saying that there is more acquisitions to come. And I think the market's kind of moved ahead of that a little bit. It's on a historical PE of like 28, 29 times, but when you're growing your earnings at 25% per annum, if you can sustain that, then that PE is probably justified.
So yes to MyNet Phone. What about Big Air?
Big Air is a business we have owned in the past. Again, it did very well, but again, it's growing by acquisition. Big Air, in the past, when we were very, very interested and we owned it, we don't own it anymore, used to have a fixed wireless business, and I used to have a student accommodation broadband business. And that was a great pair of assets, because business and corporates would use the fixed wireless during the day, and then the students would use their infrastructure at night time. So it had good capacity use of their assets over a 24-hour period. What they've now moved into is that they've got a fairly large client base, and they've made some acquisitions in the unified communication space, and they've added a few more products on. They've bolstered their team, their sales team, their support team. That's come with a bit of ingestion. They've gone through a period where they've had to reinvest back into the business to then propel forward. But it grew by, I'm looking here, it's earnings 34% this year. They do issue some shares, so that's just on a top line basis. So I think the earnings growth would be a lot lower than that. But again, my short comments, I wrote comments on all the reports that I'm interested in. Business's momentum was largely driven by acquisitions with very little organic growth, and there's lots of talk of cross-selling opportunities. So, like I said before, they bolstered the team, bolstered the support, sales, and you should really see some leverage coming in that fixed cost space coming through.
Wow. Russell, looking at Medibank Private, a lot of brokers pretty positive on the stock now, saying it's set up for double-digit growth over the medium term. Do you agree? David's absolutely right. It's not really about the policy holder growth. I think private health insurance market in Australia is quite mature, and the government's really promoted that user pays, self-insure model for decades now. So that it's not a new market. They had very strong growth earlier on, but it's really slowed down recently. So it's not about the top line growth for this. As we know, with businesses that have come out of government ownership in the past, they have a bit of fat tied to them. They're pretty lethargic. They're not the most efficiently run businesses. So there's a lot of costs they can cut and a lot of efficiencies they can get out. So one of the things that really surprised the market sort of had assumed that when they came to market, that they'd trimmed what they were going to trim, and therefore the growth was going to be a lot harder. So you saw the share price really pull off. What management are guiding to is what's called the management expense ratio, which is effectively a cost level, right? And what they're guiding to is that to improve significantly over the next 5 years. We're talking 100, 150 basis points to the bottom line. Now, they have a very, very big top line. They're the leader in private health insurance in Australia. So a decrease in that MER of any magnitude has a huge impact on the bottom line. So that's what's got the market excited. The margin expansion, is it going to be at the cost of hospitals? Well, that's on the claims side. So you've got the management expense side, which is just the business running a lot more efficiently, claims processing running efficiently, getting their IT systems running perfectly. There's no waste, there's no duplication. Those sort of things are easy for it. And then on the claims side, yes, because of their market power and their market positioning, they are putting a bit of pressure on the hospitals. There's also waste in the hospitals.
Well, from their perspective, the doctors would obviously argue there's no waste, but from the health insurance side, they're arguing there is waste. So there's also a benefit from that side as well. So if they can get their costs down as well as their claims expense ratio down, this is, we think it's worth probably 250, 260. So it's basically around there. I think the market has it pretty right. There might be a little bit more to go. It's a business we own in our portfolio.
Just very quickly, Blackmores, I mean, the stock's up more than 200% over the past year. The growth is on the back of China, which is at the centre of the market's worries at the moment. Would you be buying Blackmores these levels, Russell?
I find it very hard to justify Blackmores here. It is a high-quality business, the best brand. That's why Chinese people want it, because it's made here, high-quality product, and they're buying it here and they're shipping it off. They're paying $20 here and they're selling it in China for $60. It's very abnormal demand.
Russell, what do you think is going to turn around that share price?
This is a business we've had a bit of a look at, but we sort of moved away from it. I mean, when you have a write-down, because the economic return that that asset is sitting on the balance sheet for doesn't justify the level it's on that balance sheet for. And I think that's symptomatic of the entire business. So if you went back 5 or 6 years ago, this was a business that was generating incremental return on capitals of 20, 25%. So for every dollar you put in this business, you're getting 25 cents back. Now that return on capital or return on equity has fallen to about 13%. So for every dollar you're putting in now, arguably because that ROE is being dragged down, you're getting a return on capital that's significantly less than that. You might be getting 8%, 7%. So for every dollar you put into this business, you were getting 25 cents, and you're now getting 6, 7, 8, 9 cents. And I just think that yes, you can go out there and you can buy stuff, but you've got to cover your cost of capital, right? You have to get a return at least 10, 11% on the money you deploy. And they just have shown recently they're not able to do that with the acquisition. So they're either paying for it or the acquisitions haven't been sweated enough yet. Yeah, so they're in the business and will they better get scale from the business? I think the market is a little bit worried about that, and certainly what I hear when I talk about this business to fellow investors. Okay. Just the returns from recent acquisitions haven't been there, and they're just concerned.
And what would turn around that share price?
Them being able to demonstrate that the acquisition is adding value. So to add value, you need to generate returns above what people are willing to give you money for, and that costs you about 10%. So you need 12, 13, 14, and my net phone, 50. So it's fantastic, right? And this business is doing 8 or 9, and I just...
And is it just a demand story? Is the shoppers just not buying coffees when they go out, or not enough?
Yeah, it's not a business I've looked into in that greater detail to find out where the issues actually lie. Because it's acquisition, you probably say they might be overpaying for the assets.
Russell, what's your thought on it?
Yeah, we still use it. It's damn expensive. It costs a lot per month.
As expensive as Bloomberg.
We have to use it. There's no choice to settle with our custodian. It's very sticky, very high recurring revenue, but again, it's the financial services market in Australia is quite mature and has consolidated a lot recently, particularly on the broking side of financial services, and particularly in Sydney. That's not good because two screens become one, they consolidate. It's just a mature business for us. And then they went and bought Avalo, I think about 2 years ago, which is a business in the UK, does similar things to Australia as a lot of software for financial markets. Again, that's quite a mature business. So you've got two mature businesses effectively. You would want to see, I think, RS buy something where they could deploy cash flow and grow something over time and use their expertise here and expand that globally. But they bought another mature business, so you've got two mature businesses. It has some opportunities to continue to add to its software suite by acquisition, but for us it's mature. Just coming to that, back to that the viewer's comment on China. I'm just looking through Google now, and had a rate cut in May, had a rate cut in June, and we just had another rate cut. They're all 25 bips, right? You have to understand that the issues in China, yes, a 25 bip rate cut today might help for the next week or two.
Michael was hoping for 100.
Yeah, I mean, they need to do some serious things there because we think internally they have some pretty big issues. And we're not looking at today or tomorrow for trading positions. We're looking at the next 18, 24 months at least. we probably could see more rate cuts coming there. But these little short-covering rallies in commodity markets, and well done, David, you got it right. within the space of half an hour. It's amazing.
We'll see tonight, tomorrow.
But look, it's just they're going to be very volatile markets, but we think over the longer term the trend.
So what about M2 growth?
Yeah, like we said, MyNet Phone, Big Air, we preferred Big Air simply from a valuation perspective, trading about half the multiple, but getting similar sort of historical growth. M2, we actually caught up with Jeff Horth, who's the CEO of MTU today. We're a holder of MTU. It's not a large position in the fund, but we certainly are an investor in the in the telecommunications space. We're pretty comfortable there. The business has recently made an acquisition of a company called Call Plus. It's a New Zealand telecommunications business. They're guiding for FY16 growth of about normalised around 25%, which in this market I think is around 20%, which I think in this market is very hard to find. They see some really big opportunities in wholesale. So like Telstra has done, it's really on-sold its services to bigger companies who have then gone out and resold their products. Under an NBN world where the market's sort of levelled, they see huge opportunity there to grow their market share from about, they're looking about 7-8%, and they think longer term prospects they could get up to 12 or 15. So there's still a long path for this business to go. It probably will be by acquisition more so than organically. There is organic growth within the business, but it's around that 5% level. So to get that 20-25% growth, you need some acquisitions on top of that. And New Zealand is an opportunity for them. Australia still there's some opportunities here. So look, we're comfortable with the story longer term.
National veterinary care is at a cheaper multiple than Green Cross at the moment.
I think that's a great comment, particularly with what happened with Affinity, G8 Education. Once you get another person in there with access to capital, you can jump the prices and you really ruin the returns. And as I said, you've got to get your cost of capital. You've got to get at least that 10%. And when you've got two people bidding for assets, that can drive that down really, really quickly. Green Cross have a stated objective to grow their vet clinics by around that sort of 20 odd vet clinics per year. So they're active in the market. Then you've got another competitor, and I think they, from memory, look, I haven't looked too closely at this one, but NBC, but I'm pretty sure they had about 30 or 40 vet clinics contracted from memory. Right, so there is a little bit of competition coming to that space. So naturally, you have to think that prices are going to be driven up for the more attractive vet clinics, and that will probably reduce its attractiveness longer term. Also, you've got, I think, if you go to a doctor, and he gives you a prescription, and you want to go to a chemist and get that filled, you want that literally to be next door, don't you? You don't want to have to hop in your car, travel down the road, trying to find a park, jump out, give you a prescription over, wait. So what Green Cross are doing is, because they have the vet side, it's about 25% of their earnings, and they've got the retail side as well. What they're doing, I think it's great for people that are pet owners, is they're collating vets within the retail stores. So you can go there, buy your dog food, buy your biscuits, buy your rubber toys, and at the same time you can get pooch checked into the vet clinic. So they're trying to push into that one-stop shop. Okay. And they have access now to about 55-56% of the population. Obviously there's plans to continue to grow that business to be in contact with 90-95%, 100% of the population. So when they got that, and they got that one-stop shop, vets that sit by themselves in isolation, I think that's just going to be a harder prospect to justify from an investment. Green Cross has had its issues with acquisitions, probably paid too much for the retail assets. But look, it does have a long way for growth, and it has a bigger balance sheet and a lot more access to capital.
Okay, so for bank, but let's go to Russell first. SEEK and GBST, what do you think? Yeah,
we haven't owned GBST, but we've obviously owned SEEK, and it's a company we've spoken about numerous times on the show. Look, about half of the valuation for this business comes from its local job boards, and about the other half comes from the international potential. So look, we think after this result, they only grew about by 4%, and they're guiding for the similar growth rates into FY16. It's not a lot for an online international business, but what you have in Australia at the moment is you have a lot of businesses that are really cutting back on their investment. They're saying, we can't justify the investment, we can't justify putting that capital out, we're just going to pay it out as a dividend. Now, SEEK's gone the opposite way. They're not going to pay it out as a dividend. They're investing heavily in growing their international assets. And that's really where the story for SEEK is. And even locally, they're investing heavily. Now, short term, yes, that hurts. That hurts growth because your costs rise and you're investing ahead of revenue, so you don't get the growth. And that's what really freaked out the market. But we think longer term, the valuation and the prospects for this business actually improve. But shorter term, they're investing for growth, costs rise, market goes, I'm pretty impatient. The intention span for the market's about 2 days, certainly not 2 years. So look, there's been a bit of pressure on it, but longer term we think that's okay. GBT's is, but there could be weakness there in a fair chunk of Zhaopin, and they're in listing boards here. If China does slow, you could see job listings slow in Zhaopin in China. That's a high growth market, so you could see growth overtake any sort of decline in momentum for that side of the business. Same with SEEK. It's a highly cyclical business locally, and if we see unemployment spike, then that could hurt that side of the business. So I think the market's a little bit worried there as well. GBT, great business. Look, growth this year was amazing. The reason for the pullback in the share price was because they've gone to the UK with their administration side of their business, the software, and they've also gone to America, and they've employed some big guns to really try to get some traction over there. What they've come to the market post the result, I think led to 34% growth in earnings this year. What they've come and said to the market is we're probably a little bit underinvested in our business. In order to support growth, again, we really need to invest right now ahead of the revenue curve. So what that's going to do is it's going to depress earnings growth, and it was on a fairly high multiple when you got to $6.50. I think it's come back from there because that earnings growth is really going to slow. Costs are going to go up, and revenue is not going to flow until probably FY17, FY18 for this business. So look, I think you've got time on GBT, but high quality business and out 16 times historical, still might grow that sort of, it's not going to grow the 30s and 40s, it's going to grow more like the 10s and 15s. So that's what the market has pulled back its forward multiple.
Plenty to talk about. Okay. Russell, what are your thoughts? I mean, China wobbles, does that impact on, the Asia story of ANZ, or would you prefer to go with something domestically focused like CBA or West?
Yeah, look, ANZ have obviously a business in China or in Asia. They don't have, it's not the entire business. They do have some growth opportunity there. But in terms of the banks, I think the large reason you've seen, I think CBA got up to $95 and got down to 70 odd. So it's a 30% pullback in share price. It's a correction in anyone's language. Anyone buying for yield above $90 has to wait for a few years for the capital gains to, all the dividends to pay for the capital loss, which is a bit unfortunate. But you're seeing APRA come out and they've increased risk-weighted asset on investor loans. They're really trying to cool down that side of the market. What that means is that's been about 60% of all mortgage and lending growth. That's really going to start to slow down. So you're going to see credit growth in Australia slow down. So I think the market has looked at that and they've been a bit more cautious in terms of the share price. They're going to need more assets to support those loans, which means profitability of lending is going to fall. So their growth is also going to, from a credit perspective, is going to slow, and also from a profitability perspective is going to slow. And then you got the potential for them to not only do that for investor loans, but also for housing loans. And I think that is coming. These banks at the moment have to hold about 18% capital risk-weighted assets against a $100 mortgage. Not any mortgage in Sydney is $100. It's insane. But that's now moving to 25, 30%. So that's why they've raised a lot of capital, because they have to hold so much more capital. Whether or not it's the the APRA saying market's pretty elevated, we're a bit concerned. You need to short your balance sheets. Sorry?
No banks?
No, we own ANZ.
Okay.
Yep. And we're having a good look at Bendigo at the moment.